Hello, everyone, and a very warm welcome. On behalf of our entire team, we wish you a very happy and prosperous 2024. It's the time of the year to reflect on the year gone by and discuss what lies ahead in future. 2023 shunned every single pessimist on the street. Quite a few markets reached its all-time highs. Even Japan got out of its sleep after almost 3 decades. Gold glittered, and the notorious kids, namely the crude oil and the Bitcoin, also behaved themselves well. This is in spite of events like some of the regional banks in the US going bust, the largest European bank not remaining bankable anymore, and the heart wrenching Israel Hamas war. To discuss what lies ahead in 2024, I am joined in by Mr. Sahil Kapoor. He's the Vice President and Head of Products at DSP Mutual Fund. He has a rich experience of 15 years and specializes in asset allocation, market analytics, and thematic trends. Thank you, Sahil, and a very warm welcome to you.
Thank you very much for having me, and Happy New Year to you also.
Sahil, my first question to you remains on the broader macro as far as 2023 was concerned. We started 2023 with a very high probability that US will go into a recession. In spite of it, the headline numbers at least suggest that the economy did not bat an eyelid in spite of one of the biggest and steepest rate hikes that the US economy saw. On the other hand, China did not deliver as per expectations. As far as India is concerned, we saw an excellent coordination between RBI and the government in trying to control inflation and growth. What are your thoughts on these somewhat interlinked economies as we kickstart 2024?
So I think, yes, we did outgrow our expectations and probably expectations of global investors. We've done quite well over the last 18 to 24 months, particularly. And largely, this divergence started to become apparent in April 22. I remember distinctly that when we met internally for a discussion, the idea was that hard Indian macroeconomic data, the high frequency indicators that we watch, they were sort of accelerating versus in many other parts of the world, the data had begun to deteriorate, right? Specifically in China and part of Eurozone. Now, the idea is that, is this something that we have seen before? Uh, I think a lot of us have seen last 20, 30 years, and it makes that part of history a lot more alive, and we think about it a lot more. And that's why we sort of believe that these divergences don't exist. So I'll give you two distinct parallels of history. First is if you go back to 2002 to 2011, or particularly what is called the noughties, in that period, the global growth was very synchronous, which means that all countries were growing together. Most central banks were raising and cutting interest rates together. Inflation numbers were moving up and down together. Flows were happening together. Equity markets were moving together. In fact, even credit growth numbers in many countries were very similar at that point in time. And this led a lot of people to believe that their particular economies were very, very strong, right? Indians believe that we had the best time. Chinese believe that they had the best time, and so on and so forth. And if you fast forward to, let's say, a period of 2017-18, where a lot of countries began to display stronger growth trend, but India sort of lost on because of our own domestic issues with IL&FS and liquidity and banking issues. So we were sort of decoupling in the opposite direction. While the world was sort of doing well, we were not doing so well. So there are these two parallels tell you that if the global growth is synchronous, that means all countries are growing together. Usually the stronger ones outgrow the weaker ones, right? Because there are tailwinds, and it is sort of, a given that if a country has inherent strength in terms of that period of time, it will usually outgrow the other weaker ones. And the opposite is also true. That means when things are not so great, the stronger one will probably slow down lesser than the the weaker ones. And over the last 2 years, this is what has happened, right? While global growth, in the post-COVID world rebounded, aggregate growth over the last 3 years has been much slower than it has been, let's say, way back in 2002 to 2010 era. India's growth has also been slower than that era. It might sound surprising, but it is what it is, right? But we have outgrown others in a relativistic world, and that I think has played out to India's advantage. Can this trend continue in the future? Can we continue to outgrow others? Uh, I find it slightly tough, right? We can do that in patches. Eventually, the global economy is still very, very globalized. It's interlinked. It's very hard to continue to outperform other economies. So my sense is if we go one level, two level deeper, it's going to be a hard task to continue to outpace global growth. We will be much more benefited from a benign global environment where other countries are also growing rather than an environment which is hostile for growth. So that is how I think about it.
Right. I think it's a point very well put, wherein all countries growing together would ultimately aid in a better growth. So, Sahil, coming next to, Indian markets in specific. So we added about $900 billion of market cap in 2023, which is almost equal to the market cap of countries like Sweden, Brazil, and Netherlands. Now, India's share of global market cap also stood at 3.8%. In terms of IPOs and follow-on share offers, the number of listings that happened were crossing Hong Kong for the first time in, almost 3 decades. India's market cap has been growing by about 15% annually for the last 5 years. So, are we becoming a country where institutions can have a FOMO effect, or will we revert back to the mean and some other country is going to come and take its place?
Largely, how we should maybe possibly rephrase our thoughts around this question is, who are institutions? Eventually, institutions are people like us going to an office and wearing a tie, right? And that is how human mind works. Eventually, I believe most institutions end up making a new investment looking at the most recent price action. Uh, and there are very few who take care of the investing basics. We've seen time and again, even global flows, for that matter, FI flows, which are considered to be the smart money, end up entering countries at the fag end of their performance miracles. So, for example, over the last 20 years, China has received about $1.8 trillion, about 1.6 or $1.8 trillion in FI flow into equity markets. Okay, so its dollar performance is less than 2.5%, CAGR. And if you take certain dates, it will be negative also, right? Compare that to India, which has got only $160 billion, okay, which is just 10% of what China got, but the dollar returns are 8.5% CAGR. So now the question is that, is the money 20 years ago, for the last 20 years, was it smart enough to find out whether to invest in India or China? And are we saying that that money has now become smarter and it is seeking investing in India? And therefore, we believe that this is the right thing to do. So these are contrasting questions. I don't have an answer, but I believe that the only parameter that smart investors like us, if we want to be smart, of course, and FIs who are looking to invest anywhere, they have to keep in mind only one very important fact: are they buying stocks which are expensive or not? Right? If they can answer that question, I think that will take care of what kind of flows are coming in. Because if you break up the FI flows, almost 3/4, 75 to maybe 85% of the flows are only passive flows. That means an investor sitting outside India wants to buy emerging market. Within the emerging market basket, India has 15% weight. So if he puts $100, we'll get $15. He's got nothing to do with his opinion about India and Indian markets, right? The active money following emerging markets is a small set. Active money following Indian markets particularly is even smaller, right? So this thought that somebody sitting outside India is actively seeking to invest in India because we have something superior is right. It is aspirational in nature, but the quantum of that money is still small. It is still very, very passively driven. And therefore, I think if you go back to the answer in the first question, we will benefit a lot more if you get that money as a large chunk in emerging markets, because that number will be much larger versus getting that money only from, let's say, active funds seeking to invest in India and shunning other emerging markets. So think about these two contrasts. And that, I think, is where the real answer lies. So maybe the short answer to your question is yes, people do go through FOMO, etc., emotions. They might want to look at price action and want to invest. Can they change the behavior of the market? I don't think so. I think eventually it will be decided by how expensive or cheap the markets are.
This brings me to my third question, which is about earnings. Now, typically in a pre-COVID scenario, we used to see earning downgrades happening almost every quarter. But over the last couple of years, maybe, we have started hearing about earnings upgrade, which has not been a scenario in the last decade, except for the last 2 years. Now, given where the valuations are, as you rightly pointed out, which is of paramount importance, earnings delivery is going to become very, very critical. We wanted to understand from you, when you're talking to the company management, etc., how do you expect the earnings to happen in the last quarter of FY24 and in the year FY25? Also, most of the fund houses and the senior fund managers we are speaking to, there seems to be a consensus trade as far as certain sectors like banking, pharma and healthcare, or auto is concerned. What are the sectors as a house that you are bullish on? And thirdly, my question is, for an investor who's looking to park any incremental money, how should he be allocating towards the small and mid-cap space?
Sure. So your first question pertained to earnings, right? And as you mentioned that we had a period where earnings were downgraded repeatedly. They did not meet expectations, and now the reverse is happening. And the problem doesn't lie with expectations. I think the problem is that we get it wrong in terms of feeling that the expectations were not met. See, financial markets work only on expectations of investors, right? Certain investors who feel bullish about it, they will bid up the prices, and others, will do otherwise. Now the question is that why earnings did not play out, right? In hindsight, it is clear now that growth was patchy. A large segment of the market, which is 40% BFSI, was going through a cycle of correcting old bad mistakes of non-performing assets. It took about 8 years for that cleanup to happen. So the earnings growth was challenged. Many sectors were witnessing very poor bottom line and top line growth, a mix of both aspects. What has happened post-COVID? Two particular things. One, corporate sector went through a very large deleveraging cycle, right? Whatever profits they made, they repaid their loans. The banks took an 8-year hit to come back to a very healthy position of lending, right? And third is that the pent-up demand post-COVID allowed credit demand to accelerate. So I think these three ingredients have created very strong earnings growth. Now, the question that I ask myself is that over the last 30 years, stocks have delivered about 14% returns, okay? Which is if you look at Nifty. The nominal GDP has grown at about 12.5%, 12% or so. Profit growth is 11.5%. Okay. Post-COVID profit growth is about 22% CAGR. Can we continue to do 20% CAGR? If the answer is yes, the question is why? What is so special about us today that it was not there for the last 30 years, that we can double our growth of profits over the next 5 to 7 years? And when I list down those aspects, that what has changed, maybe yes, profitability from one very large sector, which is BFSI, would possibly be higher in this cycle than the last cycle. But I don't find ingredients strong enough for us to do 20% or 22% earnings growth. And therefore, I think we might again go back to that scenario where you build up expectations of 20% earnings growth and end the year with 12% or 13%. It's quite possible, right? And once again, I think if you ask 100 analysts on the street, including myself, what is your outlook for the next year? Almost all of them will give you an optimistic outlook. And the reason is that human beings are optimistic animals. If you go out and ask a businessman, do you expect a degrowth in your sales next year? Nobody will tell you that. Right? So this is a very, very normal answer that most people give, which is more optimistic in nature. It should not be confused with reality, right? Which is very, very different. Uh, Second part of your questions pertain to the sectors. So, what we like is in line with what you said right now, largely BFSI, pharmaceuticals, auto, healthcare. These are the sectors where we see value. And the reason is that these sectors are cheaper than the broader market. So, for example, healthcare is the only sector trading below its pre-COVID valuation and 10-year average valuations, right? Earnings growth has just started to pick up, margin expansion has started to happen. And same is the case with banking, right? Credit quality is good, credit growth is excellent. And there seems to be a 12 to 14% consistent runway for growth for this sector. And it has, for over the last 25 years, always outpaced Indian growth, right? So if you were to buy one sector which is a proxy for India, so to speak, this is one of the better sectors, because it is attractively priced today. And auto, of course, because I think there is a big replacement which is coming up from traditional to new auto, and this is the first revival that we are seeing in a decade. So these three are the sectors. It could be consensus, but if you note very carefully, pharmaceuticals and automobiles are very underowned. They might look overowned because you compare them to indices, but their weight in indices is very, very low. Pharmaceuticals is just about 3.5% of indices in India in terms of weightage. Global average is 8.5%. In some countries, it is beyond 15%. Right. So we are still very small and nascent. I think there is a lot more to be done at that end. Right. And third question was regarding mid and small cap. So one observation is if you take a look at the top 1,200 companies listed on, BSC, the 1,200th company will be about 1,000 crores in market cap. So that is a universe that I'm talking about. Remove the first 500 companies, okay, which is the 99% of the universe. The tail of the market, the last 700 companies, uh, contributes less than 5% of overall market cap, but it is trading at an average price to earnings multiple of about 70. If you remove the outliers, which of course, skews the data, the average price to earnings multiple will be close to 40 times plus, which is unheard of. If you go to other emerging markets, the same universe, the tail of the other emerging markets are trading at low single digit price to earnings multiple, right? Which means 10, 11 times, 12 times. Some emerging markets, small caps are trading below 6 times price to earning multiple. Right? That is the difference that we are sitting on. Second is that there is a large discrepancy in terms of the smaller the company, the higher the valuation is, which is exactly the opposite of December 22. We wrote back then that small and mid caps are much more attractive than large caps back in December 22. And the reason was small caps were trading at 17, 18 times earnings. Today, they're trading at 30 times earnings. So I guess the margin of safety in that segment is very low, to put it mildly. So I would prefer to put extra incremental money in a staggered manner in large caps and particularly skewed to the sectors which I spoke about. That is how I'll go about it. Within the small and mid cap universe, there are opportunities which are attractively priced. We think there is about 20 to 30% of the universe which is still attractively priced and hasn't gone up in value as much. And there you could, take those educated guess, but for that you will have to rely on a fund manager. So the idea is to, incrementally focus a lot more on large caps.
Right. Coming to consumption, India's GDP is largely driven by consumption. And ever since COVID, we are seeing premiumization, being one of the biggest trends. Now, while this seems interesting and good to know as far as the aspiration levels of, the normal Indians is increasing, but what concerns me is the bottom of the pyramid, right? Is it because of low income and, moderate to high inflation? Because the concern is that, in spite of infra picking up, construction doing all right, which is the second largest employer post agriculture, we are not seeing too much of growth in the bottom of the pyramid. So what are your thoughts on the same? And would you also be of the camp that prefers, companies which are towards luxury consumption or premium consumption, so to say?
See, the idea is that this question is two answers. One answer is more social and related to the economy. The other answer is more investing oriented. I'll give you the investing oriented answer first. If you're an investor, it does not matter. 80 to 90% of listed universe earns their top line from the urban tier 1, tier 2 cities. So you very well, can dismiss what's happening in the rest of the economy. Does not matter. There are, of course, pockets which drive a lot of revenue from rural India. But if you can avoid those sectors, you still have 70-80% of the universe to invest in, right? So from an investor standpoint, uh, the economy is doing well, right? The urban part of the economy is doing well. The second answer is from a broader perspective, where I think the broad basing of growth has not happened, particularly post COVID, which seems to confirm with data. When you look at, let's say, labor intensive IIP growth or exports or rural wage growth, all these numbers are very soft today. They haven't really improved to the levels that we've seen historically when GDP growth improves to 7.5 or 7%. These numbers have not improved to that level. For example, rural wage growth is still about 3.5 to 4%. Middling between these numbers, which is 1100 bips lower than, or 11% lower than the wage growth for BSE 500 companies, right? So these contrasting numbers have not changed. And there is some commentary from certain listed companies which indicate that this trend might change in the next few quarters for better. That means rural economy makes a comeback. But hard data is yet to, showcase that. We will probably be the excited ones in terms of when this improvement happens, but it hasn't happened yet. So it may have a lot of bottoms up implication for investing, but from a broader perspective, when you think about your own investment basket, it has little to do with how it performs. So I think for investors, more or less, who are invested in large caps, and they can ignore what's happening with K-shape or any shape of recovery.
Makes a lot of sense, Sahil, and that helps us remove a lot of noise from the analysis which we do on a daily basis. So, Sahil, my next question is about what we saw in 2023 in primary market. If we look at the list of IPOs, we had close to around 170 SMEs, and we had close to around 50 main boards IPO, which came to the market. Many of these were not just oversubscribed, but they had a very good debut also. Now, if
Right.
you look at the performance also of BSE IPO index versus BSE Sensex, it's 2:1 in 2023. Now, generally, what we have seen historically is that when there is too much of action in primary market, at
Hmm.
times it leads to volatility and some correction in the equity market in general. So, what is your view on that? And also, what's your outlook on primary market in 2024?
So the second question is, I don't know. I have no idea how the primary market will evolve. I'm not an expert. But usually what we've seen is that after a slew of issues which don't go through, the activity, overall becomes slower. So you will have to see one or two issues not do so well, and then the next few issues will go on the back burner. That's what we've seen. But in 2021, end of 21, we highlighted this fact not only in India but globally, that primary market activity was at such a peak that it did send a signal that market had become very, very, complacent. We haven't reached the same numbers as yet, uh, but I think for the kind of supply that we are seeing, sort of promoter selling and uh, the numbers from sell side also, it does tell you that there is some sort of overheating which has happened. But when we speak to some global investors, the idea that we get is that they would want some more paper to get into the market, right? India's free float is still smaller than many other markets globally. That means promoters hold a lot more share here, and many foreign investors would prefer, higher allocations over time. So it's a double-edged sword, right? I don't think that it has a straight answer, but your observation could be right that many IPOs where valuations have been out of whack or away from what they should be in reality, they have been priced at very, very high multiples, does tell you that sentiment has taken the better of investor acumen, and that is a sign of conservatism to be practiced, and that's what I think. I think we will take it as a sign of complacency getting into 2024.
Understood. So complacency, overheating, and the prudent investing has to be more about conservatism at this point of time. So
That's
Sahil,
right.
moving on from equity to one area where as a fund house, you discuss a lot and you share a lot of insight, and that is gold. Now, if we look at last few years, especially post-pandemic, we have seen gold delivering good returns in 2022 and 2023 as well. I think 2021 was a dud year, but after that, we have picked up on that. If we look at the behavior of central banks worldwide, they have been buying gold at a historic rate.
Yeah.
If we see the current price of gold at $20-50 an ounce on a 10 years basis, it doesn't look expensive, but on the near term, maybe it looks a little elevated. So two questions here. One, for an investor who is underexposed to gold, should he or she be looking at investing in gold at these levels or wait for some correction? And second, for a growth investor with the current geopolitical setup, how much allocation should be in the gold at a portfolio level?
So Harsh, I was looking at a data point where, starting in 1970s, I looked at how much has US debt gone up, indebtedness in United States versus what is the change in gold price. And I'm going to print this data and a slide in one of my upcoming reports. What it talks about is that in times when US indebtedness goes up significantly, usually gold outperforms in that period. Okay. And outperforms as much as US has printed debt. And sometimes it goes higher at an accelerated pace. And what are those sometimes? At times when dollar is weakening. That means, so let me paint that scenario once again. US is taking on more and more debt at an accelerated pace. And at the same time, if the US dollar is weakening, you will see that gold prices jump multifold, or you could see a major bull market happening in gold. We've seen two such episodes, right? Once in 1980s and then in 2000 to 2010. And in this episode, where US debt has gone up significantly, so I'll give you the numbers in September 2011, when gold prices peaked to lifetime high. US debt was about 15 trillion. It's now $35 trillion, $34 trillion as of last few days. And gold prices are at the same level. And largely being reflected because dollar has strengthened over this whole 10-year period. It's been exceptionally strong compared to its own history. Now, the only joker in the pack remains that if you see a weaker dollar, okay, I'm not talking about any conspiracy theory that dollar will fall by 30-40%. I have no idea. But even if the dollar were to weaken in its natural cyclical manner by 10-15%, it can really put gold prices under a bit, and prices could really accelerate upwards. Will that happen? I have no idea. But all the ingredients which should be present for a gold bull market are present, right? We have accelerated pace of indebtedness globally, a lot of uncertainty around growth in different pockets of the world. Third, extremely expensive equity markets in a lot of economies, right? We have accelerated price to earnings multiple in most economies. And you have also a case in point where interest rates are high and there is an expectation that they could get cut, which usually benefits gold prices historically. So the checklist is full. Will that happen or not? It's anybody's guess, but I would still err on the side of being slightly bullish. And if prices were to go above 2100, there's a good possibility that we could have a large bull market unfold.
And what about asset allocation framework getting changed for growth investors? I mean, should they look at higher allocation in gold because geopolitically we are becoming very sensitive worldwide?
Harsh, it does look like that if you are an equity investor only, you should rethink about what are you paying for, right? If you think that growth in earnings will be 10, 11, 12, 13, or even 15%, are you happy paying 23, 25 times or 30 time price to earnings multiple? Because historically, these multiples do not earn you very high returns. You should be happy earning some bond plus returns. This is what history says, right? Anything can happen in the future. But if that is the case, then you should be looking to invest in other assets, which probably will give you more uncorrelated price behavior. One, of course, is gold. The other could be also equities in other parts of the world. As I said initially in initial comments, that the world is not so synchronous anymore. There are a lot of countries which are available cheap. Their growth is bad. People don't want them. Investors are fleeing those countries. It might be a good time to look at them, rather than looking at where everything is great, right? So it should be sort of a contra view that you could take. And also bonds appear to be an asset which are giving you very good, point of entry, whether it is duration or the rates that which are available right now. I think they are an asset class which you should not ignore. So asset allocation, I think, is the first port of call. If you are putting your fresh 100 rupees today, and the answer is yes, you should be looking to have a higher allocation to some of the alternates to equity.
Sahil, you mentioned about looking at other geographies which are not looking as expensive, and during the course of your discussion, you mentioned about emerging markets. So my question is specific to China. Now, if we go back in time, when 2023, if we would have discussed it around 12 months back, many portfolio managers worldwide were bullish on China at that point of time. But
Right.
over a period of time, we have seen all those expectations going away. In fact, if you look at the performance, China's CSI index is down 14%. Nasdaq Golden Dragon versus Nasdaq Composite, the underperformance is close to 50%, which we have never seen earlier. Now, in the light of all this, one question which people have started asking now is that is China becoming another Japan? Though
Mhm.
Japan had a very different performance last year, but over a longer period of time, is it becoming like that? And secondly, just to understand from you that when the trade becomes very, very crowded, like for example, if you see the two trades which were very prevalent in 2023, one was going long on US technology and second was going short on China. Does it make sense for investors to look at these in the opposite direction or in a contrarian way? So to summarize, what is the outlook on China in 2024 and emerging markets?
So the answer to first question is outlook. I have no idea what will happen in 24. The only thing that we know today is that stocks in China are cheap. Second answer that I have about China is that we can't have a very broad index type of an approach in China, particularly. You have to be slightly more nuanced in terms of what you are buying, or you have to be more quality oriented or tactical in nature. Third thing is that China is available attractively, right? So it is good to scout for opportunities, right? What kind of opportunities can you scout for is the topic of a long discussion. But yeah, you could be constructive about not just China. There are other markets also which are available cheaper. So, but I must also tell you a red flag that over the last 15, 20 years, many of these markets have not performed. And the reason is that their earnings growth has not happened, right? So there is a reason why many of these markets have not performed. And the comment that is China becoming another Japan, I think is maybe just about 18 years late. Uh, Shanghai Composite peaked in 2005 and 2006, and it is 50% below that price today. So it's been 17 years, right? So I think it is slightly misguided in terms of how people are looking at China. It has not delivered return for a very long time. Hang Seng Index is below its 1997 price today. So this is the history that is there. But the point is that many of these data points were also true for United States. People don't realize it today that until 2013, S&P 500 was sitting on 14 years of no returns. Right. So these data points are true for many countries, including India. From our 2008 peak to COVID bottom, we were sitting on 1% CAGR. Right. So many countries depict this trend again and again, and it happens everywhere. And I am more concerned about markets which have rallied for a very long period of time and they become expensive. I'm not very concerned with markets which have fallen for many, many years and become very cheap. I think the margin of safety is much higher in those markets. So that is how we should think about it. And the second question pertained to, the overall valuation, if I'm right,
Right.
in terms of alternative markets. I think for let's say you talked about Nasdaq Dragon Index, and that contrarian approach that we should exercise. There is no way to judge it, Harsh. I think it's largely performance driven, right? when we look at last 12 months, 24 months of data, we start to think that these markets are contra in nature because they've fallen. That may not be true, right? It may not be true at all. So it's very hard to judge what the market sentiment is because the data and analytical proof is very hard to find, right? I don't know how to say whether India is a consensus buy or a consensus sell. The reason is a lot of people say that we are getting so much money, but we are also getting a lot of sellers, right? Whoever is buying from somebody, right? So it's very hard to pinpoint what data points will construe to give you an accurate measure of where is that point of contrarianism, right? I would prefer to look at more hard data in terms of valuations, whether it is PE, PB, EV to EBITDA, what are the ROEs, what are the ROICs, how many companies are able to beat their WACC. I think there are many other more bottoms up indicator which are useful rather than looking at returns or market expectations because it is very hard to quantify them. And that's what I think about them. But yeah, I think in terms of these 2-3 markets, there are reasons to believe that some of them have extended beyond their historical means. For example, Nasdaq trades at about 30 times, 32 times trailing earnings. SOX, which is a semiconductor index, is trading beyond 40 times trailing earnings. So these numbers are very wild and prone to get you outcomes which are not very favorable.
Sahil, with this, we come to the end of our discussion, and we would not let you go without understanding the risk to the market. Though you have alluded to a lot of risk during this conversation, but still to be specific. Now, Indians are very, when they invest their money, they want to link politics to the economics. And at times it's true, at times it's not true. So we
Yeah.
see a few investors who are sitting by the sidelines, waiting for elections to be over and then deploy the money. And the other dimension to that is the valuations at these levels. Now, for an investor who's looking to incrementally deploy money, one, you answered that it should be large cap, it should be sector driven where the valuations are relatively attractive. But should an investor go by asset allocation and just deploy the money? Should it be systematically invested? Or one should wait for the event, which is general election, where the market has discounted that the current regime will come back again. Wait for that because the predictability at times can be different from the reality, and deploy the money after the election. So, how should one navigate through this?
Sure. So, Harsh, I think there is no answer which can fit everyone. Of course, there will be individual choices on how they will invest. So, generally, asset allocation questions, I generally answer that there is no, I don't know, right? Because every investor is different, their time horizon is different. But if we were to build a hypothetical investor, I would always prefer to put money in a multi-asset kind of a framework where you don't have to think about, buying what is expensive and buying what is cheap. You will always have an asset class which is underperforming and outperforming at the same time. So your uh, capital curve or the volatility of your portfolio will be slightly lower than if you were to invest in only one single asset class. So I think that is always a point of call. Second thing is that if an investor can, in a very disciplined manner, invest only through SIPs forever, he does not have to worry about any of these things, right? Because he is accepting average prices at average valuation with average returns. So he does not have to worry about any event. He does not have to listen to market commentary, including our reports. They are useless for them. The only underlying factor is to be disciplined, which is what is the most hardest part about investing. So I would prefer a more diversified multi-asset portfolio or a portfolio which is staggered in nature, which means that I invest over the next 12 months incrementally every month. And I don't think about where the market is or what the event is coming up. And politics, elections, uh, I can give you one data point which is very interesting. Go back to every single Indian election over the last 20, 30 years. Prior to every election year, there has been a crisis, right? So, for example, before 2009, you had 2008 global financial crisis. Before 2014, you had 2013 with uh, twin balance sheet problems. Before 2019, you had INFS in 2018. right? So right now we are not sitting on any crisis, right, so to speak. But when you backtest these data points and link them to election, you are actually backtesting these events which occurred which nobody would have predicted, right? And therefore you get some data points which tell you to be bullish or bearish, and it is actually just noise, and you can just ignore them. The only outcome from historical data that we could gather is that these events can introduce volatility to the market, and if you can safeguard yourself from that volatility and not make those mistakes, that I think is enough. And that is the only takeaway from elections and these years, that you should safeguard yourself from making outsized mistake by investing in something which appears to be extremely crazy and very, very lucrative. You can just avoid it. You will be happy.
Understood. So you're saying diversification and discipline at times can overpower analytical edge also, which is very
Absolutely.
interesting.
I think
And
always. Not at times, always. It will always overpower analytics, because eventually you are accepting average outcomes, and average outcomes are still better than bond returns. So that's the idea.
Thank you, Sahil, so much for this data-rich discussion. And it's very rare that we meet, experts who are so good in data and who have such a command and explaining things in very, very simple ways. If I have to jot down the key learnings that we had from this discussion, one was that we believe that FIIs are smart and the money is smart, but is smart money actually smart or not? That is something which is debatable. Optimism and reality should be treated differently. Tail of the market in India is trading at a much higher premium with respect to history as well as the peer group. Wage growth in rural India versus wage growth in BSE 500 companies, there is a clear divergence. All the ingredients of bull market being in place in gold, and many emerging markets have not grown. We just look at the equity market performance, but we don't analyze the earning growth because many of them haven't had earning growth also. So with this, we end our conversation. Thank you so much for your insights, and I'm sure our investors are going to learn a lot from these inputs and will help them navigate 2024 in a much more confident and a much more productive way. Thank you again for taking out time. Really appreciate.
Thank you for listening to me patiently. Thanks a lot.